Brad Williams, Frugal Finance. Let's talk about yield to maturity or internal rate of return. Basically tells us how good a deal you're getting when you invest money or take out a loan. Here, if you invest money or lend it out, you expect to get more money back in future. Yield to maturity or internal rate of return is like the magic number that tells you what interest rate you're effectively earning on your investment. Imagine you're lending $100 to someone and they promise to pay you back $150 in 5 years. Yield to maturity or internal rate of return is the interest rate that makes that $150 in the future worth $100 today. If yield to maturity or internal rate of return is more than what you'd earn if you just put your money in a bank account, it's a good deal. If it's less, it's not so. The internal rate of return is the discount rate that makes the present value of future cash flows equal to the outlay required. Or it is the interest rate where net present value equals zero. If the net present value is zero and the internal rate of return is greater than zero, we know that the return on capital, in this case, we're using return on capital, is greater than the cost of capital. This is the fundamental rule of finance. Successful projects have returns on capital greater than the cost of capital. And for equity investors, the return on capital should be greater than the cost of equity. Here's a simple calculation. Internal rate of return is equal to 1 plus I to the fifth. We're solving for I. 100 divided by 7/6, 1 divided by 5. Simple algebra. Remember that log normal stuff? So we're not using log normal. We're just inverting this power to 1 divided by 5. So our internal rate of return on this investment is 9.22. Does that matter? Well, we didn't have a starting number. We just asked, what is the return? That $50 return over a 5-year period, it's 9.22%. If you have what's called a hurdle rate higher than 9.22%, it's a bad investment. We can translate this over into a car loan. Now, let's say you're thinking of getting a loan to buy a car. One lender offers you a $5,000 loan and you pay back $9,000 in 4 years. Isn't that the exact same thing here? $100. The lender gets back $150. $5,000. Lender gets back $9,000 in 4 years. Your friend offers you to lend $5,000 at 12% interest over 4 years. What's the better deal? To see what is the better deal, you calculate the yield to maturity or internal rate of return for both deals. The lender's yield to maturity or internal rate of return is about 15.83%, while your friend loan has an interest rate of 12%. Clearly, friend's deal is better because the interest rate is lower. So go with your friend's loan if you want the better deal. That's what this is all about. Frugal finance, finding the best deal. Lender equals internal rate of return equals 5,000 equals $9,000, 1 plus I, 9, 5. It's the exact same thing. All we're doing is changing the numbers. 1583. Friend's loan is equal to 12%. So here we go. We have this payment at 12%, payment at 15.83%. We're just going to do simple math. 5,000 times 0.12. This is just annual. $6,000. 5,600 times 0.12. All we're doing is looking at payment. 672, $5,000 plus 753, 861. This is the interest cost of your loan. Here it is at 15.83%. You either pay $28.86 interest or $4,002. You remember this guy says $5,000 wants $9,000 back. Well, here it is. It's a rounding issue. Loan of $5,000, principal interest 7,886, $5,000 principal and interest $9,000. Annual payment, $1,971, $2,250. Here it is right here, $9,000 divided by 5, and then we have this 12% interest. As they said, you're going to pay 12% interest. So there's no guessing room. What we're trying to do is figure out your monthly principal and interest payments, and this is just a way to do it. You don't have to try to find a specific formula. You can just break this down using some common sense. This is a layman's approach to doing this. I want you just to figure out what the logic is here. It's really just $5,000 and then interest in year 1. And then here we have interest for year 1, year 2, and year 3. And you multiply that times 12. Simple stuff. Brad Williams, Frugal Finance. Thanks for watching.